So here's class 8. What we'll do here is we'll finish up alternatives. I know I usually do a review of where we've been so far. This class will do that second as we prepare for exam 1, question 1, bring everything together. Hopefully not for the exam, but for your life as a finance major. This is extremely important material, so we want to somehow move it into your long-term memory, permanent memory, so this material stays with you for the rest of your life. And then we'll get to the second exam question on exam 1, the tactical asset allocation, which is really my favorite because it's the pure application, taking everything you've learned and be handed a brand new situation and being able to give advice or input on that situation, what someone should do with their money. So let's finish up alternatives from page 21 of your class notes. We were starting with commodities, getting into commodities. So remember, we're under real assets. Under real assets, remember real assets provide diversification and protection from inflation, especially really high inflation. The two real assets we've already covered are real estate, especially commercial real estate. We're ignoring residential real estate in this class. Timber, which is a favorite asset class of mine, provides some incredible career opportunities. And so here's the third real asset, which is commodities. Commodities, they don't act as a group. They're all very, very different. So energy is very different in agriculture, and even within metals, there's certain metals that are very different. Like gold is a unique metal that does very different things. We've seen gold zooming up rapidly this summer. We've seen energy prices falling dramatically, especially gasoline prices and oil prices as people stop driving. And in agriculture, it's all over the place. It just depends. So they have unique correlations. What most people think about with commodities and correlation is commodities tend to be in a super cycle, a very, very long cycle. Like gold. Gold is on an extremely lengthy super cycle. It did extremely badly in the 80s and 90s as inflation came down and everybody was investing in stocks and bonds. Recently, it's had its periods because it does well during the crisis, and we've had 3 crises so far: the 2000 dot-com crisis, the 2008 financial crisis, and now the 2020 COVID-19 crisis. Gold has done really well, so in those type of extreme events, gold is very strong. But other metals like steel will not do well in those crises because people stop their construction and using certain metals that are used in construction anytime the economy slows down. A good place to see a list of the type of commodities that there are is FinViz. FinViz shows a list of all the future contracts that they track, and most people get their exposure to these commodities through futures. So I want to switch over to FinViz's website. So here is FinViz. It's just finviz.com, and I'm under the button for futures. You notice at the top it's the stock markets. Today is a really strong stock market. The day I'm doing this recording, no telling what it will be when you watch this for the class. But that's the first row is stock indices. You might have used some of these for your paper 1, including the VIX index. So these are all related to the stock market. The second row, you see 4 buckets over here that are all bonds. So bonds are what we've been talking about when we talked about treasuries and corporates. These are all treasuries. So those are not commodities. So our commodities is energy. Then you get into agricultural, and the metals, more agriculture, and in currencies. We do not consider currencies part of commodities. So our commodities are the energy, the agriculture, and the metals. For energy, you have crude oil. You both have WTI, which is West Texas, and then you have the Brent. And you can notice these two are really very different right now. And that has to do with some really crazy things that have gone on in the last few months where we just had too much oil and we couldn't store it. If you look back at oil prices, you can click on these and you can go back quite a ways. And you'll see when oil just fell through the floor because of the lack of places just to store it. It got really, really low. Some of y'all heard of negative oil prices. What the negative was specifically tied to a particular futures contract that was maturing in that month. And that's a case where if you had a futures contract to buy oil, there's no place for them to deliver the oil to you. So people were actually paying money to get out of those contracts so they wouldn't have to find a place to store their oil. Very, very unusual. But you can see how FinViz will allow you to bring these in. This is where I got the charts for your paper one. It's a really good site. You should remember it. They do a good job. You see up here on the top right, you can click whether it's monthly, weekly, daily, or hourly, every 5 minutes. Depends. Like for our paper one, I probably either did hourly or 5 minutes. So you could see the reaction of the market. Probably it was 5 minutes. So you could see the reaction to the market to a particular event that happened during the day. Whereas if you're doing a paper, a longer term paper, you might want to click on the monthly so you can go back 20 years or so and see what oil prices have done. So it's a very, very valuable tool. So I'm going to go back to the futures. So there you have energy. But again, WTI and Brent usually move right together, but they have gotten off. Gasoline, my word, it's shocking to me looking at what gasoline prices normally go up in the summer, and they've done that this summer, but boy, they got extremely low, obviously, when no one was driving. But it just amazes me how low gasoline prices have been. Then heating oil, natural gas, it's been pretty amazing how low natural gas has gotten. Then ethanol. So there's your energy. Mainly it's oil and gas, and I mean oil, gasoline, and natural gas. Then you get into your agriculture, things like cocoa, cotton, orange juice, coffee, lumber, sugar. Down here you have live cattle, feeder cattle, lean hogs. Down here soybeans. Corn, wheat, rice, oats, canola. So you get all your agriculture, and you'll notice on these they go in very different patterns. You know, we can look at gold and see on the metals how gold has really jumped up this summer. Now that there's been recently people talking about a vaccine, gold, as the time I'm doing this video, has sold off some. It had gotten to all-time record highs, but it sold off here recently because people were looking at the vaccine. A vaccine comes in, gold usually does badly when the U.S. stock market does well. So you can see here in 2008, 2009, well, gold did pretty well in the 2008 crisis, kind of sideways though for a while there, but at the worst part of the crisis, gold actually recovered pretty well. But recently, gold has done extremely well, especially during the COVID-19. But recently, just in the last few days, you're seeing gold having really come down. So very sensitive, but gold reacts very, very differently than, say, orange juice or coffee. They're all on their own little cycles and all driven by certain things. And that's the diversification benefit of commodities. So you see gold and silver, sometimes they move together, but silver is used in production. Gold is generally not used in production. So if we're not doing much construction, or depends on what it's used in. So copper is more construction. So you know, it depends on the actual metal and what fields. Is it construction? Is it automobiles? What exactly is the commodity used in, and then you have to look at that. You look at the bottom, they give you the one-day move. So the VIX is down a bunch today, but that's because the stock market's up today. So the VIX goes in this exact opposite. Lumber, we talked about timber. Timber's up a bunch today. I don't know why, but it's up a bunch today. Gasoline's up a bunch today off of a very low base. You see natural gas is down, so that's interesting. Gasoline is up, but natural gas is down. Platinum's down, so I can't answer why each one of these as they are. It's one other area you can specialize in finance. You can have an entire career where your entire career is soybeans. Understanding that market, the supply, the demand, what drives it, government policy, what's going on with exports and imports. So there's an area there where you can really get in the details and become a specialist in those areas. So FinViz, great site. Remember it. Put it in your list of weapons that you can use for other classes and then early in your career as a really good source of information. So those are the main commodities. You can purchase a basket of commodities. There are some exchange traded funds. We'll talk about exchange traded funds or ETFs a little bit later in this class. But there are two major ones, the GSCI and the AIG commodity indexes. So the S&P GSCI and the Dow Jones, they are very different. The S&P GSCI has traditionally been 60% energy. Now I think it's probably come off. It's probably in the low 50s now because energy prices are down so much. But it generally is very dominated by energy, whereas the AIG industry is intentionally kept more balanced. So it's usually only about a third in energy, and it probably hasn't come down in its energy mainly because they keep it balanced. So let me show you where we can look at these two indices. So here's the GSCI. You can see right now it's only 52% energy. They let it float with the market, so you'll see the allocation between them go up and down. Agriculture is 18%. Industrial metals, that's like silver and copper, that's 13%. Precious metals like gold and platinum, those are about 8%. Livestock about 8%, and then nothing else in other. Then when you go on to the AIG, you can see energy is still 31%. Oh, these are old numbers, sorry. So I don't know what it would be today, but they probably keep it more balanced. You can see agriculture is a much bigger part of it, like 30%, 23% in grains, 7% in soft, and then another 5%. So there's actually more agriculture than energy. And then you have your metals that are about 33%. So it looks like they're shooting for about a one-third between these. And these sites, if you go to them, you can actually go in and look at the different research. The one for the GSCI, there's a lot more information here. Performance, key facts, characteristics, literature. There's a lot that you can do because iShares, they're the ones that run this particular portfolio. They want you to buy this, and so they have an incentive to provide a lot of information that might get you to buy the ETF, but it's also information that could be really useful in another analysis that you might be doing for another class or for a project at work. So these websites are really good. So that's it for commodities. The key with commodities is to understand that they go on their own cycles. They tend to be somewhat uncorrelated with each other, and so you just have to watch the allocation. How will you spread your money between the different commodities? Because energy prices are so low, do you want to dump a lot of money into energy, or what have food prices been doing? What each one's on their own cycle, so it requires a great deal more research. All right, so look, we've got one last real asset to cover, and that's other. I'm not going to cover other anymore past this point because it's not an area I know a whole lot about, and it's extremely specialized market. And in particular, it's a market where you better know what you're doing because the transaction costs are extremely high. Many of these auction houses, boy, they keep a pretty good amount, a spread off the top when they're buying and selling these. I just saw on the Antique Roadshow, they were talking about this person who found an incredible, I think it was a painting, an incredible painting, and they sold it for $400-something thousand. But after you put all the auction house costs into it, the actual cost to the buyer was $530-something thousand. So it was a good $80,000 was added to the cost just to cover all the legal and auction house costs. So other types of real assets, artwork, collectibles, maybe bitcoins. I don't know where we put bitcoins. I don't think it really belongs here. Maybe it falls under currencies. I don't know, but it is a very unique asset class, but very specialized. So what I want to do is take you to a couple of articles that talk about these because I don't know these well, but you could certainly specialize and spend your entire career on this. So this first one is an article from The Economist. It's back from 2017. I had a tough time finding more current information. So this just shows a few of these other assets, and boy, there's some interesting groups. You got cars. It's called the Passion Index. I don't know the source of that, but cars, jewelry, and there's several others, and they talk about that in here. But you can see classic cars have done extremely well for some reason, whereas jewelry's been pretty much in line with the overall stock market. Here's another site I found. It's COUTTS, and they show I'll show this in a little bit more detail, but it shows you many more categories. We'll get into that, but here's a good site. I really pretty interesting. They have articles, they have research, so this is an area you're interested in. There again, it looks like they're trying to sell these, and so they even have more current information from 2005. This goes through 2018. It's up 90%. That sounds good, but you annualize it, it's only 5% a year. And it was not much in 2018, pretty weak year. Although 2018, it's hard to imagine that it wasn't up better because they show you what's worked in 2018. And again, classic cars had another great year in 2018. I don't know why. Coins, I have a former student who is very much into collecting coins, and he knows his stuff backwards and forwards. He could certainly start his own proprietary business doing that and trade that. Fine wine, classic watches, jewelry. So these must just be the best ones. They don't show the ones that cause it to, there's jewelry must be the worst, but how could you only be up 0.1% when these are all doing so extremely well? But you've heard of places like Sotheby's. Those are the big auction houses that, the transaction costs are huge because these are quite illiquid assets, and they're traded between very wealthy, very sophisticated investors. So you have a link to that article in the class notes. However, it is an Economist article, so if you don't have a subscription to The Economist, which I highly recommend that you do. I love The Economist. I read it every single week. In fact, I'm a much bigger fan of The Economist than I am of the Wall Street Journal as far as my view of the world, wanting to see a much bigger picture and much longer term. And it's only published weekly, so it means the stories are a little bit less noise. Magazines that are published weekly or monthly, they tend to be a little bit longer term, whereas the Wall Street Journal published every single day. There's going to be a lot of noise in the Wall Street Journal. All right, so here's that index that one site I was showing you has. It shows what's been happening since 2005, but you can just see they break up the artwork in different categories. Wine's a category, stamps, coins, classic cars, which seem to be doing the best for some reason, who knows. Rugs and carpets, musical instruments. I have a good friend who's a really world-class bass player, and he was carting around a bass that was several $100,000 in value. Some of these old violins that existed during Mozart's time are going for $1 million, but their prices will go up and down. You can see that it hasn't done well since 2005. Jewelry, watches, even properties, and here's the Passion Index. There's that 90%. 90% sounds good, but we're talking about this over 13 years. So this 90% is only 5%. So you can see some of these are well below 5%, even especially artwork. One thing I can tell you about a lot of these indices is the China effect. There are many billionaires in China, and they're very worried about the China economy. What will President Xi do? Is it possible he might start actually taking over assets? And he's somewhat concerned about the conspicuous consumption of some of the leaders in China, and so many of them were buying these type of assets in order to shield themselves. Buy these assets, hold them in another country just in case there's something happens in China. They have some assets offline that they can go to. But then President Xi started really clamping down these very, very obvious high net worth types of purchases, and so that has had an impact on this market. So there's a lot of things going on. You can't just get into this market and not know what you're doing. But it's an interesting market, but we will not talk about it again. That's the last time we'll hear about it. All right, so that finishes alternatives for real assets. So for real assets, again, it's commercial real estate, timber, commodities, and then I threw in other there at the end. So another alternative is venture capital. Now there are many large portfolios where venture capital is its own separate asset class. I don't know if you've heard of the largest investor in California, which is the CalPERS, which is for the public employees in California. They have a separate asset class for venture capital. You may have heard of the Harvard portfolio or the Yale portfolio. Harvard and Yale, they have large allocations. Some of them 20-25% allocations to venture capital. So for some people, this is an alternative. When I was at USAA, venture capital was an alternative asset class. For others, alternatives is its own separate asset class. So at USAA, we had venture capital as one of our alternatives, but we had real estate as a separate asset class. So alternatives is where you can see a lot of variety. So at USAA, we had venture capitals as an alternative mainly because we didn't have the people power behind it. We really did not have many resources. I was really the only one watching over that portfolio. The lady who gave it to me, she literally handed it to me in a shoebox. She just had everything she had in a big box, and just maybe it wasn't a shoebox box, but a big box. I moved a lot of it to Excel so we could track it over time, but it was just me. It was a small portfolio. I don't think we ever got above $1 billion on that portfolio. So a firm with $100 billion in assets, never more than 1%. So it depends on the firm. But venture capital or private equity, what we're talking about here, there's a difference. Venture capital is private equity. Not all private equity is venture capital. So we're talking about firms that are not traded on stock markets. These are private firms. They're owned by a few very large institutional investors or maybe high net worth individuals. There's usually general partners who put these things together, and they have a cash call. They might have a $500 million fund, and they'll go out to the large institutional investors like CalPERS, like USAA, and say, we have a venture capital fund or we have a private equity fund we're starting. Do you want to put $50 million into it? And so they'll start them. Most of these funds last maybe 10 years, or they're expected to last 10 years. If they're venture capital, the first few years, they're just starting brand new companies. So they're brand new ventures. And many of them will fail, but a few of them will do extremely well, and that's how venture capital works. You can be wrong 80% of the time, but if the 20% is a firm that just takes off, and like a Microsoft or a Amazon type of company. I know at USA, our venture capital, we had Charles Rivers in there, we had Medtronic, we had some companies that have really done extremely well. So there may have been, most of them just didn't take off. A lot of them, they do okay, but they never become major companies. They just become small entities that make decent returns. And so these firms put together a package. They have a team. This is another area for a career in finance. I've had a few students want to do this. It's tough to get into this from UTSA because venture capital firms tend to concentrate themselves in a few cities where there's a large major university that has specialized classes in venture capital. So Boston's very popular because of MIT. So you have MIT and Harvard. Austin, because of UT Austin, has become somewhat of a venture capital hub. So they do exist. I would suggest if you're interested in venture capital, there's a few ways. Come talk to me. There's a few careers alternatives that you can do. But if you're really serious about it, then apply to Harvard, apply to UT Austin for their graduate schools, and focus in on venture capital. I do have a former student. If you're interested in this career, I could probably he would be willing to talk to you. He went up to UT Austin to get his graduate school. He's very interested in venture capital. I need to check with him and see how he's doing. I might ask him to come back and talk to the investment society to give his perspectives on what he's seen and what that career looks like. But you can certainly do it, but you have to plan it out very, very, very well. It's not an industry you just happen into by chance. You really have to work at it and have the right connections. But there is private equity that is not venture capital, and so private equity, say Burger King is a good example, Dell Computer is a very good example. These are firms that were public and they went private. So Michael Dell took Dell private because he wanted to do things with the company where he did not want the daily harassment of the stock market. Burger King, they were bought, went private. They were fixed, whatever they did to try to bring it back, and then they went back public again. Dell's gone public since then. A pretty amazing firm, huge firm, close to $100 billion in revenue, but was not traded on the stock exchange. So I say it's a way for small companies to buy small companies without the daily volatility, but there are large companies that are private. Many of the private ones might just be owned by management. They may not be in a venture capital or private equity fund. So they tend to not look so volatile. And when I was at USAA, our venture capital properties or partnerships, we only got data once a quarter, every 3 months. So we didn't know the daily price changes of our portfolios. So it looked like there was no volatility because everything was in appraise. It's very similar to real estate, where you're just getting someone's guess at what they think the companies they own, especially the first couple of years. You may have $100, $200 million just sitting in cash waiting to be deployed. So very different type of asset class, an exciting one. You may work for a firm that does venture capital. I think it's a really exciting area to be because it's the purest finance that there is. You're just valuing a company, free cash flow, where's the growth, what are the economic moats. Very interesting area. A lot of it is happening obviously in technology and in healthcare. Now we're seeing it in education. I think COVID-19 might create a lot of venture capital in education. Really exciting stuff. You might hear the term J-curve related to venture capital. You notice that the J comes down and then shoots up. And that's usually what these venture capital funds do. You have negative cash flow for 2 or 3 years, maybe even 4 or 5 years, where you're getting these companies up and running. Their business plan is being executed. They're buying capital. They're growing their market, but they're unprofitable the first several years. And then suddenly, after 5 or 6 years, they suddenly see their profits shoot up. And at about the 10th year, they start going public. They do their IPO, their initial public offering. Those are exciting for me at USAA. Every time a stock went public, because I was responsible for that portfolio. It was a small part of my job, but it was exciting. I had to make the decision when we would sell that stock. And so I did a big analysis on when exactly to sell it. I looked back several years, looked at several IPOs, and my recommendation is we hold it for about 2 weeks and then sell it. And it just looked like the sweet spot to sell these. You're often limited. You cannot sell right at the IPO. There are sometimes some restrictions when exactly we would get our shares of stock. But I always won. We usually did not hold these very long after they went public, mainly because we didn't have I was not a portfolio manager. I was just an analyst. We did not have a portfolio manager, and they didn't want to trust me because I was just a few years out of college. So, so my job was just to say, when do we sell it within a very short window, a few weeks. But interesting stuff. Definitely can be an entire career there. So we are about halfway through the class. So this would be a good time to hit pause, so go get some water, or something to drink, or something to eat, and think about what we've covered so far. Right. One last category on alternatives, which is alternatives is other, but we have others. So when we think about alternatives, what else could go in this category? And this is where there's a lot of debate. Some people consider hedge funds as part of their alternatives. I do not. I do not consider hedge funds an alternative asset class. I consider hedge funds as a way to really just get alpha, and we'll talk more about alphas. But to me, if you're trying to beat the market, hiring hedge funds is the way to do it. Or they could just be, and we'll look at some hedge fund strategies. Some of them are very stock-like, so they would fit under the stock category. Some of them are very bond-like, so they fit under the bond category. I do not consider it an asset class. It's more like a strategy. So some also think of derivatives as an alternative asset class. I definitely do not agree with that. To me, options and futures, and we will talk about them at the end of the semester. They're my favorite topic, especially options. I'm a huge fan of options. So we'll talk about them at the end, but I do not consider them to be an alternative asset class. I consider them to be a way to execute an asset class. So you can buy commodities or you can buy futures on commodities. It's essentially the same thing. You can buy stocks or you can do options on stocks, and you can construct it in a way where it's very similar to buying stocks, or you construct it in a way where you get a very different type of payoff, but it's still an exposure to the stock market. Some do believe currencies as an asset class. I have been there. We did have currencies as an asset class at UTSA for a couple of portfolios. One was in our pension plan where we used currencies as a separate asset class, and then I had to manage. I had to manage our operations overseas, the portfolios there, and we had to hire a manager since I couldn't really manage those portfolios because I'm not awake at 2 a.m. in the morning or 3 a.m. whenever the UK market opens. We had to hire a manager there, and we also hired a currency manager to manage that. So you could certainly do that. It's an area that you can specialize in finance. If you're still trying to think about your specialization, currencies can be a good one if you love economics. Currency managers usually have masters and often PhDs in econometrics. They understand Fed policies, central banks, inflation, interest rates, very economic-centered type of investors. So it's definitely an area you can specialize in. Let's look at a few examples of hedge funds and just maybe give you a high level of what we're talking about here. So I got this from Investopedia, and they have a list here that you can link them. So you can just say primary or popular hedge fund strategies and find this Investopedia page. And long short equity, to me, that's just stocks. But what that means is they can mean maybe 130% long and 30% short. Merge arbitrage to me is very stock-like. Very interesting strategy where two entities have announced an intention to merge, but they haven't merged yet. So maybe one firm offered $40 for the other firm. So their stock might shoot up from $30 to $38, but it doesn't go all the way to $40. So this firm's offered $40, and the stock of the other company only goes up to $38. They do what's called merger arbitrage to try to take advantage of that. Event-driven, a lot of these are related to the credit side. A firm that looks like it's teetering on bankruptcy, maybe a JCPenney or a Kodak right now, those type of things. Kodak certainly be event-driven. Fixed income arbitrage, that's what the BlackRocks of the world do, using their fixed income skills. Short only is pretty unusual, but these are people who really think they can take advantage of overpriced securities and they can short them. I'm not sure what the bottom line means. That's the first time I've seen that. I was a big fan of market neutral. We did that quite a bit at UTSA. Market neutral is when you're long stocks and short stocks, but in a way that your portfolio is not exposed to the stock market. If the stock market is down 20%, market neutral might be up 10, might be down 5. It should be completely independent of the market. Convertible ARB is related to convertible bonds. That's not an area I know very well, but that used to be one of the most popular hedge fund strategies. For some reason, it's dropped off the last few years. And then credit, you can definitely do credit. There's some specialized areas in credit, especially firms that are near or in bankruptcy. Probably the one thing I think of there on credit is Oak Tree Capital. It's run by Howard Marks. I recommend that you go into YouTube and type in Howard Marks' name and watch his YouTubes. He's been interviewed on podcasts, so listen to his podcast. Very famous company, very well known. He's written some books I would recommend. You should read his books. I think he says he has one called The Most Important Things, and I forget how many things were there, there's Howard Marks right there, and even a video you can watch here. So interesting stuff. But they do a lot of this buying these very shaky firms that are really struggling. He was buying a lot of these several $100 million a week worth of these companies in late 2008 when no one else was investing. And boy, he did extremely well in 2009 and following, making those investments. So that's the credit side. Global macro is probably my favorite of all. What Global Macro does is they decide whether they want to be in the US stock market or the UK bond market or the Australian commodity market or whatever. Commodities, bonds, stocks. The markets they like, they go long on. The markets they hate, they go short on. And it's very much very traditional finance. This is another one of those very traditional finance. You do valuations. What is something worth? What is it trading for? You avoid things or even go short on things that are expensive, and you buy things that are cheap. Then you have quantitative. One of my favorite is managed futures. They don't have managed futures listed separately. I would probably put that separate. But managed futures is the exact opposite of global macro. Managed futures, they don't care about valuations. They're looking at where markets are moving. They're looking at very much at technicals, and they're following the trends. So 2008, global macro did horribly in 2008, but managed futures did extremely well. So I really love the idea of combining global macro with managed futures. If you're looking for a great answer for an interview question, or they may ask you for an investment idea, you might look that up, combining global macro with managed futures. If there's a lot of people that would just blow them away for an undergraduate student to talk that type of thing. So expose yourself to some of these issues. I'm not a huge fan of Investopedia because I think some of their definitions are a little too high level, a little too simplistic. But I would recommend start with Investopedia and then maybe move to Wikipedia, and then try going to some of these hedge fund sites and just see what they're writing about. So let's say you find global macro really interesting. Then go on to Google and just Google largest global macro hedge fund managers in the world, and then see who they are, and then go to their websites. So one of my favorites is AQR. It's run by Cliff Asness. Cliff Asness, his last name is A-S-N-E-S-S, Cliff Asness. Incredibly good writer and speaker. Go on the YouTube or go out and Google his name, find the articles and podcasts and interviews that he's done. There's so much great wealth of information out there for free that if you listen to a few of these things, that will give you some great ideas that you can incorporate into an interview and separate yourself incredibly well from other undergraduate students. So here's some of my favorites here: long short equity, market neutral, global macro. There's others. Market neutral, this idea of paired trades. We won't talk about this in this class except for just a little bit when we talk about portfolios a little later. But it's two stocks that are highly related to each other, but you think one's expensive and one's cheap. So maybe Walgreens and CVS usually move together, but suddenly CVS shoots up 5% and Walgreens shoots down 5%. And you think the market's overreacting to some bad news from Walgreens. So you buy Walgreens, you short CVS, you wait for them to come back together. That's a paired trade. I've done a few of those in my career, and they're very interesting. You better know what you're doing there again, because you can lose a lot of money, but they're very interesting trades. So that's it for this exam 1, question 1. So take a deep breath and let's see how much of this that you know. So here's the outline of the answer right here. I want to go through this, but before we do, I want to give you a few rules about answering this exam. First of all, it must be in your own words. No copying and pasting. You will get 0 on the exam answer if you put this in, if you just copy and paste. I do not want to read my class notes. If there's too much overlap from class notes or other students' papers, including from prior semesters, I've had some students that are 80–90% copied. This applies to your papers as well as exams. Usually with exams, we're doing them closed book in class, but because of COVID-19, I'm doing some of the questions as open book. So because of that, there are some students that are really tempted to copy and paste and even copy other students' papers. And then when I point it out to them, they're like in shock. It's like, I don't know how that happened. Well, there's just no way you can have 80–90% overlap and there not have been copying and pasting going on. So some students will get 0s on this question, and this is a huge part of the exam, so don't do that. The other thing you need to do, and this is where the critical thinking comes in, I've given you my organization. You need now to organize this huge question in your own logical way that's integrated. So you understand how to get from one section to the next section. How do you introduce a section? So you're going to start talking about stocks. So how do you introduce it? Well, you can introduce it by just start talking about stocks. But a better way might be you just finished talking about bonds. So now you get the stocks. You might start off with, unlike fixed income, unlike bonds, stocks represent ownership in a firm. Well, that sounds a lot more professional. It's much more logical. It shows that you understand that you're moving from a bond category, which is loaning money to a firm, versus a stock category, where you're actually an owner of the firm. You have a really good transition. It's integrated. And that's what you want to get to, is you want it to sound professional. So many students will ask me, how many pages should it be? What should I do? And your boss will not answer those questions. Get out of the student mode, the student mindset, and start thinking like a finance professional. Finance is unique in that there's very little training. They expect you to take what you learn in college and just apply it. At first, that was really scary to me, but after a few weeks in the profession, I thought it was liberating. I loved it. I could essentially do whatever I wanted to. If I didn't know how to do something, I would look it up and figure it out. That's where you are. There's no more of this. You have a professor that tells you how to do everything, even though I'm giving you a very, very well kind of structured template. And it should stand on its own. Someone not taking this class should be able to look at your answer to this question and it makes perfect sense to them. Don't just start talking about bonds without setting it up a little bit. Don't just start talking about duration. Say, okay, bonds is you're loaning money to a firm. It's fixed income. Bonds have several different categories in order to separate the risk that you're taking, and that's where you bring in DC cuts I. Set it up, make it logical, make it flow, and even be willing to bring in some extra material, maybe even some independent research, maybe something I've talked about here, talking about global macro or something like that. Boy, you get excited about that, you read it, bring that into your answer. Why not? Your goal is not to get a grade in the class. Your goal is to be the greatest finance person on the planet, and you do that by learning this stuff permanently. And that's a good way to do it. Get excited about it. One of the biggest things they ask in an interview that they're trying to figure out is curiosity. I hear that word over and over again from recruiters. Is this student curious about finance? Do they have the drive that they love finance so much that they will research on their own without being asked? Something interests them, they see something. That's what you've got to convince them. But you may not be curious about finance. You may have picked the wrong degree. And now would be a good time to find that out and change degrees. Come talk to me. There's a lot of different areas in finance, so it may be possible you don't like this class because we're talking about investing, where you might really like the corporate side. But find that out, and that's the best way to figure it out. Are you curious about the stuff we're talking about in this class? That needs to all come through in your answer to this question. You now see why I hate the question, well, how many pages should this be? I don't know, somewhere between 1 page and 5,000 pages would be sufficient. What drives you? What are you interested in? Just prove to me that you picked the right degree in how you answered this question. So here's the outline. You're going to start off by defining what is an investment portfolio. So you have that definition now. So you're essentially, with this answer, you're essentially going to word it in a way, you can think it in a conversational way versus as in a paper way. So someone's come to you and said, or your uncle, Thanksgiving, your uncle comes to you and says, hey, I just inherited $500,000 from a relative I didn't even know I had. What should I do with this $500,000? Hey, you were taking that investment class at UTSA. That's a great school. What did they teach you? And you say, well, Uncle, you're building an investment portfolio. Let me tell you what an investment portfolio is. It's a collection of assets and securities to help you achieve some future purpose. So before I can help you in building that portfolio and telling you what to invest in, I need to ask you 3 questions. And then you go through the 3 questions. Why are you investing? What's the horizon? Are you going to buy a new house in 2 weeks? Are you going to use it for your grandkids' education in 3 years? Are you going to use it to put into your estate, so when you die in 20, 30 years, it'll pass on to your heirs? Do you need it for your retirement? Are you going to put it into a portfolio that's actually you're drawing on for retirement? Why are you investing? So that horizon is so critical. The next question I got to ask you, Uncle, is what asset classes can I put you into? Are you okay with stocks and bonds and cash? What about real estate? What about high yield bonds? Are you okay with that? What asset classes can I put you into? You will have your own asset classes. You might have 10, 12 asset classes, but you've got to figure out which asset classes your uncle can get into. But you have that list of 10 or 12 you're willing to draw from. Then you're going to figure out how are we going to execute this. So you sit down with your uncle, figure out why he's investing, what he can invest in. You now know what you want to do. Now you got to execute it. So you say, okay, Uncle, you want to do this yourself? Do you have comfort with investing? And probably he doesn't, because he came to you, or he would have just done it himself anyway. And then you say, Uncle, well, do you want to try to beat the market, or you want to just go passive? Let me tell you about the difference. And we won't cover that in this part of the class, but later we will talk about the advantages of active versus passive. So maybe we'll cover that before Thanksgiving, and you can bring that into your answer. And then you say, okay, well, Uncle, there's 5 major asset classes: cash, bonds, stocks, and alternatives. And cash and bonds are essentially the same thing. It's loaning money. So let me tell you the difference between cash and bonds. I'm saying, let me now tell you about cash. Here's what I have to do with cash. There's no subcategories with cash. So you go through that. Now let me tell you about bonds. Bonds are fixed income. You're loaning money. Bonds can be classified, and that's where you go through DC cuts I. And remember, on DC cuts I, you want to define each one of those. What is duration? What is convexity? What is credit? You want to give the subcategories. So remember, on duration, it's short term, intermediate term, and long term. Talk about this different categories. On the define on duration, you have that formula for minus duration times the change in yield. You have the word definition of duration. Convexity, you have a definition. There's only 2 subcategories: bonds with positive convexity, bonds with negative convexity, and embedded options. You have your strategies. If I think interest rates are going to rise, then I want to shorten duration. You might ask your uncle, hey, what do you think about the economy? Interest rates are really low right now. What do you think? Well, I think they're going to be low and stay even lower. I think things are going to be terrible next year, and interest rates will just get lower. Or I think we have a great rebound coming, and interest rates are going to shoot up. So that's the kind of thing you want to cover under the major asset classes as you get through each one. So for stocks, we had bucks, beta, U.S. versus non-U.S., which we'll probably talk about last, capitalization, and style. Define them, subcategories, and strategies. But don't forget, for stocks, you have the introduction to stocks. What is the expected return on stocks? Current dividend yield plus expected earnings growth. Expected earnings growth is very closely tied to economic growth. And economic growth is driven by productivity, labor growth, and inflation. So you talk through those. So you just go through that for stocks. You go through that for the alternatives. So, start putting your answer. Hopefully you've been doing it all along and creating a really strong answer. But do it in a way that you can conversationally do this. I can tell you right now, your uncle is not going to say, okay, I have $500,000 to invest, nephew, niece. So I invested in A, in large cap stocks, in B. You do not get those kind of questions in finance. That's not the way the world works in finance. Finance is a very theoretical, very subjective field. So you have to be able to do this conversationally. So your answer should be constructed in a way that if you were sitting down with your uncle or your aunt or whoever, your grandfather, whoever, you're sitting down with them at Thanksgiving and you're doing this off the top of your head without any notes in front of you, how smart would you sound? Is he going to say, wow, that UTSA, that's the greatest school in the world, man, you're so knowledgeable? Or, my word, why did you go to that school? You didn't learn anything. How will you sound? What have you learned in this class? Not for the exam. Who cares about the exam? What have you learned for your career? So we'll work on this more in our next class, and you'll see how we'll do that. But you need to definitely have it drafted out in a way that makes sense entirely standalone. All right? So if you want this, maybe put it on pause and do a snip of this. I don't have this in the notes anywhere. I'll reiterate this again when we do the practice session in the class. All right. We don't have a lot of time left, but we want to get into my favorite part of this part of the class, which is the tactical asset allocation. So what we will do in this question, this one will be, I'll allow you to do open notes as well, but it will be very time constrained. So you've got to know what you're doing. You need to know this. If you don't have this learned, that you can do it off the top of your head, you will fail this part of the exam. And a lot of students do very badly on this question. And it's probably the most important one of the entire class because it's the most critical thinking application problem we have. This is where you really test to see if you're understanding what we are doing in this class. So I will give you a scenario. We'll walk through several of them, including a practice session that we'll do. I'll walk you through a scenario or a forecast, and you are going to give an asset allocation in terms of what do you want to overweight. By the word overweight, I mean you want to have more in that asset than your strategic weight. So your weight, to say large cap growth stocks might normally be 20%, but you think tech stocks are going to continue to do very well. So instead of your normal 20%, you want to put 30%. You want to overweight. And in which asset classes underweight? I've had a few students get confused about what does overweight mean and underweight. The weight is the percentage that you want in the asset class. I'll show you a little bit more about that in a future session. Show you a very real life way that it's done. We don't have time to do it in this session. So overweight, those are the asset classes you love. That's the ones you want to allocate more to. Underweight, those are the assets you do not like. So on the exam question, I will give you a scenario and then I will give you a list of asset classes. It will not be all of them, but a list of asset classes. And then you have to give a tactical allocation. One of the asset classes I will not give is the very first one, stocks versus bonds. That is not in my list. So you just have to remember to have stock versus bonds in your discussion. Now what I've done here with this list, I'll do this again at the beginning of the next session because I want to make sure everybody's getting this. We'll do this a couple of times. But for each one of these, there's more than one answer on some of these asset classes. So stocks versus bonds, you're mainly focusing the overall strength of the economy. If you're expecting a strong economy, you want to overweight stocks. If you're expecting a weak economy, you want to overweight bonds, especially high quality bonds. Within bonds, you're looking at duration. That's really where do you expect interest rates to go? Convexity, what do you expect about the volatility of interest rates? Quality or credit risk, again, very much like with stocks versus bonds, the strength of the overall economy. Taxes for munis versus corporate bonds, you want to know, do I buy the municipal bonds that are tax-free or do I buy the corporate bonds? So taxes, that's the only issue taxes comes up is munis versus corporates. On inflation, should I buy tips or not? For structure, And US versus non-US, I don't really have that in the tactical exercise for US versus non-US on the bonds. We definitely will do US versus non-US on stocks, but not on bonds. So these two may not be hit at all. And then on stocks, you'll notice with stocks are always tied to the strength of the economies. So if you think it's going to be a strong economy, you want high beta stocks. If you think it's going to be a strong economy, you want small cap stocks over large cap. If you think it's going to be a strong economy, you like value over growth generally. Weak economy, you want low beta stocks. Weak economy, you want large capitalization stocks, and you want to get out of stocks and move to bonds somewhat. So this is real key with stocks. If you do not like stocks, then you want to say, I want to reduce my stocks and move more in the bonds. And then key phrase, within stocks, I want to be heavier toward large cap stocks because I expect a weak economy. And I want to be heavier in high beta stocks, large capitalization, growth stocks, and a weak economy within stocks. Even though overall I want my stocks lower, within stocks I want to concentrate on certain types of stocks. And then US versus non-US, I'll tell you something about the different countries' economies, and there'll be some comment about currencies. And then alternatives. Did your boss say anything about inflation? Was she worried about diversification? And there may be some special issues. I might say something about, I think commodity prices are too high and we're coming down or whatever. So she might say something very specific about a particular alternative asset. So be ready there. Maybe she'll say something about timber. I think the housing market in the U.S. will be really strong. So those commodities like steel and concrete and timber should do well as interest rates stay low and mortgage rates stay low, whatever. So sometimes it's just a matter of reading what's there and reacting to it. So what we have to do here, and we're running out of time, so we'll get into this next time, is understanding exactly what I'm looking for. So part of this is making sure you understand what I'm looking for. I'm very picky on this, very detailed. You need to understand that when I give you a question about treasuries, that there's two things you need to talk about. Duration. Are interest rates going up or down? If they're going up, I want short-term treasuries. If the interest rates are falling, I want long-term treasuries. Quality. Did I say we're going into recession? If we're going into recession, I want to buy treasuries because they're high quality. So we'll start here in our next session, and then we'll get into our first example, or several examples of tactical asset allocations.